Hi everyone, this is Ben. I publish the All in the Reflexes Substack that you can find on this link in front of us and through the QR code. I also publish regularly on X if you're interested in my charts and commentary. Today is October 12th, and this is the third video where I just want to go through some of the charts that popped up as interesting when I do my weekly screens for shifts in trend and strength in trend. This is particularly interesting because we had such a strong drawdown in the market on Friday that things that do not make a new low when the rest of the market is drawing down are either trend reversals or they're things that are showing a strength, and they could be interesting opportunities to follow up on later. But everything that we go through today is purely educational. Some of these things I may pursue personally. I like to share my outlook so that I can track my progress in the market. But everybody's risk preference and tolerance is their own, and nothing that I do here is targeted towards anybody's specific goals or portfolio. So, taking a look at the weekly screens, I set up a screener. You can create a custom indicator on TradingView and then add it to your favorites, and then you can use TradingView's Pine Screener to trade for them. So I wanted to find things that were, that when we had the Friday drawdown, did not make their weekly low that Friday. And I wanted to find things that made a 26-week low the prior week and closed above it on Friday. So I set up this indicator. It's very simple. And so we're looking at the prior low, and then we're looking for that to be better than the low of the prior 4 days. We're looking for that to be the Friday close to have been higher than that. And then I'm also looking at the period over the prior 6 months, and did we make a 6-month low the week before and then close above that last week, and then were both conditions met? So it's just a really simple indicator, and I ran that against both my watch list of stocks, and then I ran it against a bunch of sector ETFs. So none of our sector ETFs made a 26-week low and then had a Friday close above it. So nothing there screened for it. But we have a number of sector ETFs that, and you can take a screenshot of this to take a look at for yourself. But we have a number of sector ETFs that had a Friday low that was higher than any closing low during the week. So they did not make their weekly low on that large Friday drawdown. The one that stands out is this RPAR, is a risk parity ETF. It's not one that I trade or invest in, but it's interesting to see. Let me switch to a different chart and we'll pull it up. So so we'll take a look at RPAR. And I'll take the Bollinger Band off. I'll put the 65-week EMA with its 10-period simple moving average of itself. I'm going to take volume off, and we've got I'll look at this with just a MACD. This is the volatility weighted MACD. So you've got this risk parity ETF, and this looks an awful lot like a break above a base, right? And so this is supposed to be a close enough. All right, so we've got a base below and a break above it. Sometimes we can use these as like a measurement for a forecast, where we might take let's take our range, and if we were to take a potential for a measured move, I'd look for where it consolidates near the top of the base, and not necessarily the very top of the base for my forecasting, and that kind of lines up with the top of this harmonic that we've calculated. So if a risk parity, if instruments that present risk parity are what the market is interested in, then we could see a move in those instruments that continues much higher. So so interesting that you know, made a higher low on Friday as much of the market made a lower low. And so it actually almost retests a very small base from the prior month. So that's an interesting one to take a look at. But when we look at the list of the sector ETFs that you know, that made a higher low on Friday, we've got the Swiss franc, you've got the U.S. dollar index, you've got uranium miners and junior miners, uranium ETF. Biotechs are probably most interesting to me right now, and a lot of the metals. So we saw the metals sell off in the midweek, and then not make a low, you know, made a higher low on Friday. You've got your utilities, consumer staples. You know, these are your risk off sectors. And then interestingly, Bitcoin miners did not make a new low on Friday. They actually made a higher low despite Bitcoin selling off so hard. And then also of interest, you've got 3 bond ETFs, the IEF 7 to 10 year Treasury bonds, your 20-year Treasury bond ETF, and your 1 to 5 year U.S. bonds. Those all made higher lows towards the end of the week. So that what's interesting about bonds making higher lows is that you know, when it comes to the asset classes, they tend to your funds top in a sequence, and look at the trend health. So they top in a sequence that goes from treasuries to equities to commodities, and then the U.S. dollar index. And so, you know, you've got a little bit of strength returning for treasuries as equity, though it's not really showing on this chart. They actually are showing the same type of reading, but what we saw in the market is the strength is newly returned for treasuries, and is degraded on Friday for equities. And this is some of the most strength that we've seen from the U.S. dollar in the near term in a very long time, and gold remains strong across the board. So gold dipped down, the metals dipped down, and they recovered to a higher low. But these the ETFs that stood out as making a higher low are to me are the biotechs, probably the most, and I'm trying to think if there was another one that stood out. That's probably the one that's most interesting to me, as well as palladium, which is is a good industrial metal, has seen a lot of strong movement. So let's take a look at each of those. So on a weekly basis, this one also, PALL Palladium ETF, also popped up on the on a breakout finder. We'll turn the drawing tools off and shift to weekly. And so this is showing us a weekly breakout. I really like to just use this for screening with the ETFs. It's not a indicator that I use for trading, but it helps us to understand that this is like on a very long-term basis. We've got a base that we really haven't pulled very far away from, even though we've had a massive move in palladium. We've seen this 40% since the summertime is a hell of a move, but we're just now coming up above the. I'm trying to clean some of this up. I'm going to turn this fib off and this one off. So we're just now breaking above the AVWAP from the prior weekly high in all the way back to March of 2022. We get a fake out, shakeout, and now we've got our breakout. And commodities move differently than equities. So if this was like an equity, we might expect clean fib levels, but commodities are a story of booms and busts that have real industrial purpose. And unfortunately, the COT report is not available, which helps us to understand the way that the producers of commodities sell their futures contracts. That won't be available until the government shutdown is resolved. Until then, we might actually see fib levels more strongly respected for a commodity like palladium. But this is a very strong breakout. It's if we look at the RSI, it remains in bullish territory. It's finding support at its slower moving average and breaking above its faster moving average. You've got a positive crossover above the zero line on the MACD. So this is a strong trend for commodities, and they made a higher low into a drawdown week. And so I like that a lot. One that I do not like is, let's take a look at the retail sector ETF. So this looks like a failed breakout, right? Like it started to get towards the top of a base and faked out and reversed. And so strong bullish setups, failed bullish setups become strong bearish setups. And so if we were forecasting just from this base, I would have been, maybe looking for, like a move like this. And now that it is has failed on us, we could see the retail sector ETF plummet down pretty far. So this is one that's concerning. It's breaking the RSI for it on a weekly basis. It's breaking through its faster moving average. That moving average is rolling over into a downward slope. It's breaking through its slower moving average. And we're positioned for a bearish crossover of the MACD and its signal, and the MACD histogram looks like it's close to breaking below zero on a weekly basis. So what the retail sector does this week will be very important. It needs to see a strong recovery to remain bullish, otherwise we could slip into bearish territory. When we look at bonds, this is some of the U.S. Treasuries. This is some of the best movement that we've seen from U.S. Treasuries in a very long time. On a daily basis, I don't know if we've had a bullish RSI crossover, and we dipped below that moving average. The faster moving average was descending. Now it's curling back up, and we're breaking above both of them with some positive bullish divergence going for us, and the MACD, the volatility weighted MACD, is going to have a bullish crossover on the daily for MACD crossing above signal, and the histogram looks like it's going to have a crossover. So this is some of the strongest movement that we've seen from Treasuries. We've got a gap up, and these made a higher low and a higher closing low into the drawdown last week. This is good because we said that things top in the order of Treasuries, then equities, then commodities, and then the U.S. dollar. So the battle here is really, is this going to exhaust very quickly, and then strength is really tilted towards commodities and the U.S. dollar? That's bad for equities. But if we see a lot of strength for Treasuries, then equities could see a move back up next. Now, let's take a look at these with a point and figure chart. And so on a point and figure chart, these are the settings that I use. I'm just using the one at stockcharts.com with a free account. I like to use a scaling of percentage with 3 boxes for a reversal of 1%. And I find it helpful to have colored columns used. So let's take a look at the last two that we saw. We have XRT was the bearish pattern that we saw, the bearish signal that we saw, that failed breakout on the weekly chart. And point and figure, what it's doing is it's putting an X in every price range, and these are 3% ranges, right? So every time it completes one of those price ranges, we're getting an X, and it'll do that in a consecutive order until we get a downward movement, and then we get a 0. And so it tells us like how much of how directional the trend has been, and takes time out of the equation. So I use a lot of like time and cycle analysis, but this helps us to just purely see the trend. And in this case, we've had a really consistent downtrend that is now broken below the previous uptrend, and this is a double bottom breakdown. So it tells us that the retail sector trend itself is fairly strong in a downtrend. Now we'll take a look at TLT, and we've got the opposite. We've got a double top breakout, and we've broken well above our prior downtrend, and if we see TLT move above like 93, I think that'll be a triple top breakout. So that one looks pretty good. Now, let's take a look at an individual name that stood out as concerning to me on the weekly chart was General Motors. So GM. So what I say a lot is, a failed bullish pattern is a strong bearish pattern. So we got to the top of a base, and this move failed. So now, again, if we use the bottom of a base to somewhere in the nature of the high of the base, then we could have forecast this move to get up to like nearly a 2.618 level extension, and instead it failed and broke back below its base. And let's look at the cycle time for the base. So bases are somewhat of a cycle, and the time that it takes them to form is reflective of like a cycle length. So in this case we had 190 days. If we divide that by 4, we've got almost 47 days, almost a 50-day 1/4 harmonic, and it looks like it failed. Failed within 33 bars that it broke back below its base. So this isn't even like a really a 1/4 of the. Maybe if we take it from here, yeah, it's close, but it's it's not a perfect not a perfect 1/4 length. I'd say what it's doing when we get to the end of October is going to be important. Like if we get to October 28th and it hasn't curled back up, then this could be, it could test further down into the base by that time frame. Maybe get down to the 0.786 and retest the AVWAP from the prior high. But General Motors looks fairly bearish to me right now. So if we were to see a bullish recovery on it, I would look for that to get back up here and take out the AVWAP that the volume weighted average that we anchor to the 29th of September, where we made that failed high. It's got to get back up there and reclaim that before I would be bullish on this name. I don't know that it's safe for a short right now because we could see some bearish bounces that broadly impact the market, but possibly if it fails into that AVWAP, it might be something I would consider personally for a short. But this one does not look good. Also, on a weekly basis, this is in the Encyclopedia of Chart Patterns. This is considered a pipe reversal, where you have you've got two larger candles that each make highs and then they reverse and fail, and you've got a candle that opens and closes below the low of the prior, below the closing low of the prior candle. So that's considered a pipe reversal, and those tend to be on a weekly basis, a very reliable bearish signal. So GM's not looking real good. Now we talked about these sectors that made a higher low. So let's take a look at a few of those. So we've got the uranium names. This is likely to, got a lot of drawings on this one. This is likely to be a group of commodities that continue to have interest in the market, and but again, what we need to be aware of with commodities is that the demand is driven by use and not not subject to the same emotions that we see in in the equity market. So this is pretty far above its base in the breakout, and then you've got a basing pattern. You've got this basing pattern, a breakout and retest, and then we launch. So it'd be interesting to see if this, how much life this trend has in it. Now, while uranium made a made a higher low on Friday, this is not a very encouraging candle. You've got this long upper wick and this flat doji body. So this, that's a pretty bearish looking candle. Not a dragonfly, or is it a long upper lash? But anyways, so this is not a very encouraging candle, but uranium has been one of the stronger sectors in the market. We'll take a look at the uranium miners. Very similar type of candle, long upper body, had a bullish close for the day, put in a higher low for the week, but again, this is not a very encouraging candle for continuation. So we want to see what it does over the next couple of days. And then the junior miners in any of the commodities are typically the higher beta instrument to trade, and again, similar story, long upper body. We want to see more for that. This is a very sustained uptrend though, and it does look like it's cooling. You've got a bearish crossover on the MACD signal, so this could be a cooling trend that we want to maybe not chase. Let's see, we looked at TLT. Let's look at the Dixie. So, on a daily, this would be a pipe reversal, but pipe reversals are like, like tweezer tops is another thing they call them, right? But they're not quite as reliable on a daily chart as they are on a weekly. They're very strong. But you've got, some really bullish movement in the U.S. dollar index. You've got a bullish RSI crossover. Its prior bearish crossover didn't retrace very much. It actually continued higher and was a bit of a fake out. So you've got this, you've got fake out, or you get your fake out, your shake out, and now maybe we're going to come up and challenge. So this is one to watch. It's not going to be a massive range of movement, and unfortunately the UUP US dollar ETF is just very low liquidity, so not something I like to trade unless we're in like a real risk off environment. But this does have a bit more bullish of a look to it. Now, one of my favorite charts right now are the biotechs. Biotechs have broken out of a triple top. Let's take a look at the point and figure. And so you've got an ascending triple top breakout on the point and figure. We would need to see these. Let's see. So we closed at 105. We would need to see these probably fall below, 100, 101 to 100 before I felt like we were at danger of like a reversal in it, in a failed breakout. But biotechs tend to do well seasonally into December. And we can see that we've had measured moves out of biotechs in the past as well. So I'm going to zoom out on this chart, and one phrase that I'll say a lot and that you'll hear a lot are the wider the base, the higher the space. And so we put in these lengthy basing patterns, and then using a ratio of time to dollars, we've got 785 bars in consolidation in this rectangle, and then you've got 10 cents per dollar. 78.50 would have been a forecast if we're using a 10 cent per dollar ratio, which I'm using pretty rounded ratios when I look to lock the aspect ratio of a chart. So I'm using generally 10 cents, 5 cents, a dollar, $5. I like to use ones and fives so that it's pretty consistent. So in this case, using that, you can almost forecast it to have gone up to 180, and it made it up to 173. So in this case, we've got a slight break above that rectangle, and you've got 954 days that it took to form this base, and now, if we were to use 10 cents per dollar, that's a pretty extreme move. So I'm not, predicting this is what's going to happen. But I'm prepared to participate and give a breakout from this rectangle a lot of flexibility, because if we were to see one of these massive moves, you can see that they come with a lot of shakeouts. Biotechs are really volatile, so we get continuation higher. I'm going to take profit along the way, buy on retraces to supporting moving averages and harmonic levels, but biotechs look like they're probably positioned to be one of the stronger things that we see in the market in the near term. And in terms of their closing low, so this is a bullish engulfing candle, so it completely engulfs the body of the candle before it. It doesn't engulf the wick, but it's still your candle body has a higher open than the prior day's close, and then closes lower than the prior day's low. That's generally a bearish reversal sign, but we're seeing an instrument with a strong breakout from a wide base. So let's see what it does from here. But this is a pretty bullish looking sector right now. Now, three charts that I think for individual names. I'm not big on many individual stocks, and we've just seen a big market drawdown. So there's not a lot of things I'm looking to make new trades or purchases with until I see what direction we're taking. But Friday I posted a few things on SKWD. This is an insurance company. This has had some pretty nice runs in the past. We see we've had these really big bullish moves upward. We've got this failure here now. That failed breakout looks a lot like, or this top that we see over here looks exactly like the Justin Emme's sentiment cycle. You've got your enthusiasm, your subtle warning, your overt warning, and then you get a panic sell-off, despair, and then you get a wall of worry, anxiety, denial, returning confidence, right? So it showed us that subtle warning, overt warning, boom, right? And now you've got, you've got the, you had your panic, and possibly this was our anxiety, right? Movement in that pattern. You can see it just replays over and over in the majority of stocks. Grab a sip of water real quick. So, taking a look at a couple of the drawings for this, we've got our fib ratios back here. This is where we had our failed top, and failed bullish moves, present bearish moves, right? So it did get all the way up to the 1.618, which is generally where so actually this met our forecast, back here in May, and then reversed from there. So we're going to want to see this reclaim the anchored volume weighted average from that May high and get above it with a retest. So I'm thinking that the scenario that I would look for here is we're going to fail into this thing, come back down to a moving average, then we break above it, then test it as support, and then we start to build our way out of a base, right? And then we're going to want to get above the base that forms with that prior high in May before we have a shot at this upper range. And we have to figure out where do we have a consolidation near the top of the base to forecast from. But this looks like a really early indication that we're seeing some strength and a change in sentiment. You've got a bullish crossover on your volatility weighted MACD. You've got hidden bullish divergence from your RSI and price low, and then we've had a divergence from the behavior in the rest of the market, where we saw and again, this is a doji. These are not really encouraging candles. We don't have very wide of a movement, but this is a higher low for the week on a week where we saw the market draw down in an instrument that's very deep into its downtrend. So this is a sign that we could be seeing this insurance name, you know, put in its low and start to build a recovery. Now, let's look at its earnings performance. You know, this is a winner earnings wise. They've got double digits growth in EPS, double digits growth in sales, and their next earnings come up in the early part of November. So we have a little while before we have new news come from them. So this is one that's I've actually participated in with some call options, and I'm going to continue to keep an eye on and maybe add shares as well. But I'm going to want to watch to see those recovery behaviors that we drew out. Two more names that I want to take a look at. So Anon is On Holding is in the retail sector. So this is a consumer non-durables apparel. So we said that, you know, consumer discretionary does not look very good right now when we looked at that XRT chart. But then we saw that ONON put in a higher low for the week when the rest of the market put in a lower low. And you've got, a steady bullish divergence in your RSI. You've also got it on your volatility weighted MACD, and it's not, you know, quite a strong bullish crossover yet, but this is a signal that the downtrend might be fatigued and exhausted for this apparel name. And this was a pretty high beta name between like 24 and the beginning part of 25. So you've got this, you know, we failed to make a new high after the April low. And that was our bearish sign, right? Like this would have been a really strong short when we see a lower high after a big market drawdown where the rest of the market's recovering, and then it falls below that moving average volatility weighted MACD with a strong reversal. Like that would have been, I wish I'd seen that for a short, but this is looking like a strong place for it to make a stand for recovery. It's got I'll go with the bigger one. Nope, that's the wrong thing. So your anchored volume weighted average from the 2022 low was tested in April, and we've not come back down to it. The one from the 2023 October low, we fell through it in April, in that April drawdown, and now we're back above it as support. So that's an encouraging look, and we're going to want to see a move above the AVWAP that we just anchored to the May high, and a very similar thing that we're going to look for with SKWD. It's, you know, if it's going to do well, it's going to probably have some trouble at this octave, which is starting to align with that AVWAP. We'll have it come back down and test something, and then we'll get above, see a little bit of resistance, and then get into like an extended recovery scenario. So, you know, this could come up and into like a failed top, but, you know, if you see something that's like, we're looking for a confirmation to take place around the $48 mark, and possibly a failure into a base that would be between 50 and 58.63. That's a pretty strong move. You know, that's yeah. So from the point that we would be looking for confirmation, you know, we would be forecasting like almost a 30% move. So it's that's something that I would like to participate in if I see it. So this again might be one that I play with call options that are dated out into like December, January if they're available. I haven't looked at this one on the options chain yet. And then one last name that I want to take a look at tonight, and then I'm going to sign off. Coca-Cola. This is interesting because we had Pepsi make a strong recovery last week, and Coca-Cola might do something in sympathy, but and this is in part because the staples made a new higher low last week, so we might see some of the staples names pick up. And so, this is an inverted hammer. At the, when you see these into a price high, that's not very encouraging, and there really hasn't been anything encouraging about consumer staples in a long time. So we'll have to see if this is at all meaningful. But some names in the space might do well, and Coca-Cola might, like we said, might have a move up that mirrors what we just saw with Pepsi. But this candle looks different than what we saw with XLP in the staple sector. So it's coming up, and it's running into the bottom of a descending 34 EMA cloud, and so that's concerning. I'd want to see it get above this, and also above this AVWAP. Maybe recover this one first. So it's going to bump into this one, and we'll want to see it get above there. Probably run into 69, come back down to maybe the 68 area, and eventually get back above this. But this put in a positive close and a higher low into Friday, and this also closed higher than a 26-week low. So both SKWD, ONON, and also KO had a 26-week low last week and closed higher than it this week, and then also closed higher than the lowest low of the current week on a day that the market sold off. And now what's interesting about the move with Coca-Cola is we have this gap back here in February, and in our recent that recent low, like closing low in at the end of September, was just about the middle of that gap, and I really like to see when price comes down to test a gap and doesn't close the gap, like comes down to the middle of the gap. That tells me that buyers were looking to step into this gap and buy this gap early, and when people are bearish, they're looking to sell gaps and protect their profit like up to the top of like the opening of a gap. So when the middle of a gap holds a support, that's more bullish for a reversal signal to me. Other people might treat them differently, but I take that as a pretty encouraging sign. So let's see if this one does something interesting for us. We've got we haven't had a bullish crossover on RSI yet. It's not a very high momentum name, but if other things get ugly in the market, this could be one that does well. We'll take a look at that move in Pepsi. So you had the, like a breakout move in Pepsi. This one I've got the circles on this chart. So so this one's a little bit goofy. So with this approach, I'm looking to take considering the GAN boxes and circles that are proportioned the same way as the GAN boxes, to see if we're going through like a lower basing pattern or maybe breaking out. But Pepsi, I had an options call with it, or an options play with it, and that worked out really well, but not a name that I'm looking to do much else with. But yeah, this is encouraging. We've got a break above that 34 period moving average. It's about to reclaim its 65-week moving average. RSI is close to getting a bullish crossover, and Coca-Cola might follow it. So we'll look to see if that happens. So that's it for tonight. And if you guys want to do a live chart review, again, please do that survey. Let me know what you're interested in talking about and what days work for you. But thanks again, and have a good night.